I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by our macro advisor, Edge manager Craig Shapiro, for our Edge clients, so we can really get into the nitty-gritty of some of these very, very exciting moves in gold and food, of all things. And let's just first review the macro and the Powell testimony. Hit it.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Yeah, so we're in a bubble. Risk on continues across multi-assets, whether it's crypto, whether it's big cap tech, whether it's small caps, whether it's meme stocks. It's been basically everything. And my sense is that it's been driven by this idea that the economy is fine, inflation has been solved, and the Fed's going to be cutting rates this year, and everything is great, that this immaculate disinflation has been achieved, and the Fed soft landing has been achieved, and so we are off to the races, and the Fed mission accomplished. And I think what's been going on in more recently is that the data, both on the growth and on the inflation side, has been pointing out, has been doing better than expected after the significant loosening of financial conditions that we've had over the last, 4+ months, really, since the end of October, early November, when Yellen changed the composition at that QRA, and then followed by the Fed, dovish pivot in December. So we've had a significant easing of financial conditions, which has had a real impact in the economy, and it's allowed for the labor market to remain firm. It's allowed for consumption to remain firm, and we're seeing that in better growth and better inflation data. And so my thought has been that this loosening of financial conditions would make it more difficult for the Fed to achieve its inflation goals for this year, for next year, and that they'd be forced to remove some of the cutting expectations that they had originally intimated at the December meeting and in the January meeting. And we came into the year, market was looking for 6 cuts. We've since removed at least 3 of those, or 2.5 to 3 of those. So that was the market realizing it had gotten too far ahead of itself. But now we're into the phase where I think the Fed needs to start to realize that the economy is too strong and inflation is too robust to deliver that. And so I thought that there was a chance that Powell would deliver that kind of messaging when he spoke to Congress yesterday and today. He did do that last year at the similar Humphrey Hawkins testimony in early March, after better than expected growth and inflation data. He spoke hawkishly and reminded the market that the job wasn't done. Coming into today, we had several Fed speakers on the hawkish side who have said that the data has been better, and we may have to postpone our timelines for cutting. Waller gave a speech which was titled "What's the Rush?" when it talks about cutting. So look, I thought there was a reasonable chance that Powell would deliver a similar message today and yesterday. But I had been saying that if he decided not to, we're going to keep bubbling up. And in my view, he didn't really deliver anything. He didn't really deliver any change in what he has been saying. Now, he also was not asked very many questions about monetary policy over the course of the last 2 days. There's a lot of political grandstanding, really, actually, way more than normal. Even in the Senate, which usually asks better questions, there's a lot of talk about Basel III and regulations. I mean, after listening to it, you'd think this was the most important issue in America today, was bank regulations. I mean, it really shows you the tentacles that the bank lobby has into the Republican Party. It's quite fascinating. Not surprising, but when you hear every single one of them in the House and the Senate basically talk about Basel III, it was pretty wild. And even on the and then on the Democratic side, really talked more about, Republicans also talked about the border and immigration. Republicans talked a bit more about Biden administration economic agenda has been pretty good. US is doing fine. It's time to cut rates because housing is unaffordable to middle class and to poor people. And why isn't the Fed cutting rates? So there was some questions about that. But there was certainly no questions about what would happen in an environment where inflation doesn't go back to 2%. Why are you not being, there was nothing on that front. So there was really no chance for Powell to answer a question in that regard. Now, he could have come out and said something, but he didn't. And so there is informational value in there. He doesn't feel at this point like it was necessary to push back. Now, he is the Fed chair, so he really obviously knows that he moves markets. And so maybe he was waiting for the data tomorrow from payrolls. Maybe he was waiting for the CPI print next week, because after those data points, then you'll have 2 months of data that will really show what the economy is doing. And so I think, the jury is still out. If we get hot wages tomorrow and we get a hot piece, CPI next week, I think there is going to be more momentum to remove a cut for this year, possibly raise the neutral rate, remove some cuts from 25 and 26 and the like. So, but, that wasn't the message from today. So the market and yesterday, so the market has behaved accordingly. And we've continued to see NASDAQ rally, and Bitcoin's been great, and gold's been great, and meme stocks have been great, and the short covering has continued, and the year has gone swimmingly for bulls. And so that's where we sit. Tomorrow is important because we get the payrolls, and last month was a monster payroll beat, 353,000. So we'll see if there's revisions there. The Fed keeps talking about that the labor market is balanced, is becoming better balanced and slowing down properly. We'll see if that's true or not. And then on wages, average hourly earnings are expected to decelerate pretty sizably from 0.6% month on month last month to 0.2% this month. So again, I think there's an expectation for some of the strength that was seen in January to come out in February. And so I don't really have a view one way or the other. These are often coin flips. But I think the way the market will react would be if the data comes in better than expected, both on wages and unemployment, then it would be very difficult to think that the Fed is going to be bringing forward its cutting agenda. It probably, to me, would kind of confirm that we're going to go to 2 cuts for this year. And I think the market would trade on that. Certainly fixed income, I think, would sell off, and the front end would sell off. We probably would see the curve flatten even more. If we get kind of in line to mildly worse than expected, I think we'll just see a continuation of the trading that we had on Friday. It's 0 day to expiry. Every Friday is, and we'll probably just get some more risk on behavior to end the week into next week's Tuesday CPI. I think the most interesting maybe outcome would be if it's a disaster tomorrow. If we got a real weak number, how would the market trade that? I think what you'd see dollar weak. I think you'd see bonds rally. I think you'd see gold and Bitcoin rally. I think stocks would react positively at the onset. But is this market ready for an environment where the growth is really slowing and the Fed's not going to do anything about it? I think that it could be a concern for stocks. Because the Fed isn't cutting in March, and basically on everything that we said, they're not, they're not cutting in May either. And so they're going to be cutting maybe in June. And we just got if we get a really crappy payroll print, well, that's 4 months from now. That's an issue. So that will be interesting. But I think most likely markets will be, and we saw some volatility today and some hedging going on. Intraday vol was pretty bid into the close. So often that happens the day before a major release. So I suspect we'll get some vol selling either way tomorrow, unless it's a complete outlier event. So I'd say base case is we kind of keep grinding up into CPI next week, which is Tuesday. PPI is Thursday, and expiry is Friday. And CPI, PPI combination will give us a read on core PCE for the end of the month, right? So next week's, will be very important for the inflation data, and that'll give us a sense for, how to position for the Fed meeting, which comes the following week.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.